welcome to another installment of the Blue Collar Economist podcast. I'm Robert McEwen, the Blue Collar Economist. Today we're going to talk about something that a lot of economists and pundits have been talking about, and that's this huge influx of gold and silver into China and how they are positioned in the event of a fiat currency failure worldwide, mainly dollar and all those currencies that are pegged to the dollar. If they all were to fail and the world was to somehow miraculously return back to a hard money standard, how well positioned China and maybe even India would be in the world market and dominate the world as far as money is concerned. The price revolution was a period of rising prices in the 16th and 17th century Europe. This gold and silver inflation, we can call it, increased Europe's money stock, according to certain estimates, by not more than 50%, according to others by up to 500%. However, this happened over a period of 150 years, which gave an average growth rate in the money supply from between a third to 3 1/3% per annum. Around the year 1500, the total stock of money in Europe was about 3,500 tons of gold and 37,500 tons of silver. And over the next 150 years, Spain imported 181 tons of gold and some 16,886 tons of silver from its mines in South America. Now also during this time, they exported a lot of this precious metal to the Far East and Middle East, as well as they were purchasing up these fine silks and other imports that were high value sought after items by the wealthy. Now we have to remember that prior to this time period, the price revolution, Europe experienced during the Renaissance an equilibrium in prices of commodities and labor. That was mainly due to things like the bubonic plague. I mean, it wiped out like a third of the population of Europe, and unfortunately that did add to some price stability. But this huge influx of precious metal, which first arrived in Spain, gives us a great opportunity to look at the practical implications of inflation, right? Because Spain got the money first. It then later, of course, some of that money, like I said, was sent off to the Far East and Middle East. But then a large portion of that had gone up, moved northward towards France and through the Netherlands, and then later into England. And every time this new flow of new money went throughout Europe, prices began to rise. And this was something new to people. They never experienced this before, not for generations. Prices were always something that were stable, but now they were going up, and nobody could understand why. It was about this time when this was all going on that we discovered a school of thought in Spain, and this school was known as the School of Salamanca, and we call them the Spanish Scholastics. It was a group of intellectuals and thinkers who mainly were a part of the Catholic Church, who were trying to describe the world around them at that time. It was ever-changing. Old dogmas and doctrines of the church had to change because of, for one thing, the discovery of the New World and of the indigenous peoples of the New World. And other things, what we're talking about today mainly is the economic impacts of such things as the quantity of money. And because of their work was so similar to what we call now the Austrian school, Murray Rothbard often referred to them as proto-Austrians. They're the first group of people to actually come up with a workable theory of the quantity of money. Unfortunately, a lot of that was lost over time for at least a couple hundred years before it was picked up on again. But one of these scholastics from the Spanish school was a man by the name of Navarro, and he discovered through his observations that as the money supply increased, the the prices increased. And he thought, this is an odd phenomenon. Why did this happen? You would think, well, more money, more spending, more stuff. Why would the prices go down? Well, what happened was he discovered is that the value that people put on the money went down. More money there is, the least valuable it became, and thus more was required to purchase the same goods. Thus prices went up. This is, today we call that the quantity theory of money. Now this went unnoticed for quite a long time until just within 100 or so years ago. Again, economists picked it back up again. But it's sad that the Spanish scholastics who were so forward thinking and had such a great contribution to make in the School of Economics were forgotten. So why did a massive infusion of silver from the mines of South America leave Spain economically hollowed out compared to the other powers like France and the Netherlands and England? They had leaped ahead in terms of productive capacity. That partly we can answer that this way. The new silver that came into Spain enabled Spain to purchase more goods, consumer goods and capital goods, abroad. This is why the Far East and Middle East saw an increase in their money supply, because this is what the wealthy in Spain did with their money. Spain felt wealthier because they actually were wealthier, and they had a larger share than previously on claims of gold and silver according to the world's ledger, right? But because at the margins their society was less well positioned to increase its productive capacity, capital flowed to better positioned societies like those in Northern Europe. And those societies saw a longer lasting, durable increase in wealth. Again, the distributional consequences of the silver infusion made the situation worse. Because after all, the increase in wealth didn't accrue to Spanish society as a whole, because Spanish artisans and peasants weren't much involved in generating the wealth. It accrued to the top of the Spanish society, the cronies, the court, those dependent on the court for power and profit. Because they suffered from inflation but didn't participate directly in the influx of the wealth, the infusion of silver made ordinary Spanish people poorer, and therefore even less able to invest in improving their own productive capacity. Not like the Northern Europeans, out of necessity, did invest in those things, and thus had, in the end, had a longer lasting wealth effect from all this new money. Let me say this another way. Let's compare the old 15th and 16th century Spain to modern America. Spain was locked into a rhythm of consumerism. Those that had the wealth, the money, purchased things with it. They just spent it. They consumed. They didn't reinvest into the methods of production, something that would be long-lasting. Instead, they bought spices and silks from the Far East and the Middle East. They bought rugs and tapestries. They bought fine wines from France and imported woolens from England and so on and so forth, and didn't invest any of that money, much of it at all, into their own production. Now the Northern Europeans, because they didn't have as much wealth as the wealthy Spanish did, more or less out of necessity had to invest into methods of production. And that investment positioned them for a longer lasting wealth effect that the Spanish lost. That's why we ask, the Spanish Armada and the Spanish Empire was so huge and vast. How did they just suddenly, like overnight, just go into oblivion? That's why. The French, the Netherlands, and the English were all investing into production, something that was longer lasting, and they weren't out just on a shopping spree like the Spanish wealthy were doing. And that's the in a nutshell, That's why the Spanish Empire failed. Of course, the Spanish Armada being sunk, and so on and so forth. But economically speaking, that's what happened to Spain. They never did recover. They never really had the money or the capital to go into South America and really invest into South America, other than to exploit it. Not like England and France did in North America. Now, there's a lesson to be learned here, because this is the trend America is falling into now. Our interest is now, because of Keynesian economic theory, is spending. That's what we do. We buy. We import. We import from China. We import from other markets around the world, and there's very little productive capacity in the U.S. anymore. And if we're not careful, we'll find ourselves going by the way of Spain, especially since the dollar, the U.S. dollar, like the silver back then, is seeing a huge influx, not only here but worldwide. Now, at the beginning of this podcast, I wanted to compare the old Spain to modern China, because China is also at this time importing mass quantities of gold and silver into their country, just like Spain's had been doing. And there's been questions arising. If the dollar were to collapse overnight, say all those peg currencies to the dollar were to go down, and hard money advocates got their way, and we went on a gold and silver standard, wouldn't the same thing happen to China? Wouldn't they see massive price increases? And what would happen to prices throughout the rest of the world, since the rest of the world isn't as highly positioned in gold and silver like the Chinese are? Would their prices go down? And there would be some of that, I would think. In my analysis, I believe there would be some of that. But we have to understand that China has a highly productive infrastructure. They are the world's producers at this time. And infusion of hard money assets like gold and silver, and then that asset become money, I think it would only increase China's productive capacity, and would position them even better in the world than they already are, as far as that's concerned. But then again, we would have an equilibrium, because the Chinese would still spend their money, and knowing they have to export all their goods, the importing countries would have to then purchase that with something. That would mean China would then have to purchase products from other countries with their gold and silver, which would add to the influx of the metal into those countries. So there would be an equilibrium over time. It wouldn't happen overnight, maybe not in a year, but maybe over a decade, some time frame. And you'd see a water level effect, like water in a bathtub. Gold and silver throughout the world would begin to equalize some. Well, it wouldn't be exactly even. Those who have the highest productive capacity would, of course, maintain a higher claim on gold and silver, since their economies would be in better position. But then other countries would just have to catch up, just like the East did today. They caught up and surpassed. But at the same time, we have to remember that China is still a communist country. They're not a free market by any stretch of the imagination. It's a command economy, centrally planned. And what would the Chinese produce? How would they know what to produce and what quantities? What do they know as far as other cultures around the world, what they'd want? If all the production capacity was centered in China, what new inventions would come out of China? What new innovations? There aren't any now. The things they produce today are innovations and inventions that are researched and developed in other countries and then just manufactured in China. So I think the rest of the world would still play a key role in production. I don't think there would be a shutout that wouldn't be beneficial for the Chinese nor for anybody else, that the Chinese shut out the rest of the world. It is a global economy, and I think it would still remain one. I think the roles that other countries would play would be pretty similar to what they are today. I think in the United States you'd still see a high-tech lead type development going on, and maybe even in some of that in India, but Europe as well. But time will tell, I guess. I mean, we'll have to see how this plays out, how long the dollar will last as the world's reserve currency. That is the big question, how long the con will continue and how much confidence is in this con called the US dollar. And with that, I'm going to start to wrap this up. This has gone on long enough, and I appreciate your listening in again to this installment of the Blue Collar Economist. And remember, you can check out the website at www.thebluecollareconomist.com. That's all one word. And check me out on Facebook and also on Twitter. And until next time, have a good day.